Thank you so much. Thank you. Okay, so again, I know that we said this, but having our clients, our friends, and some new faces around the room, it's always nice to get people out to talk about the things that excite us in this business. And all of you could have done so many other things with your Tuesday evening, so we're just grateful that you decided to spend some time with us. Hopefully you find it valuable, interesting, and we'll go from there with sort of respect to what happens next. Okay, so I'll give you a bit of an overview of what we're going to do tonight. We're going to go through and talk about our team, who we are. A lot of you may already have met many of us, or some of us, and some of us it's new. We're going to talk about why real estate in general, what makes that a great investment versus others. We're going to get into how to get the most out of your mortgage. So, this is where the sort of nuts and bolts happens. How do you get to that place where you can invest in new property and, acquire the financing to do so, because that tends to be the biggest barrier for a lot of people. We're going to give you a break to refresh and everything like that. And we're going to talk about some different strategies, some ways that you can invest in real estate. There's not one perfect answer. So, there's things that the beginner can do based on your comfort level, and the things that the advanced investor can do. And, there's, like I said, there's no perfect answer for all of you, but somewhere in between is going to be what we find will fit for most. So we'll talk through some of that. And then we're going to get some examples of real life client situations that the team has gone through, and what this client, what these people or families were able to do. So first of all, who are we and why should you listen to us? So Jeff Mayer and I are all mortgage agents. We work on a team together. A lot of our clients come from the kind of background where they want to invest in real estate, they want to grow their portfolio. Jeff himself specializes in multifamily. He ran a landscaping company, so a property management company for a long time before that, and worked for some of the largest non-bank lenders out there before getting into doing mortgages on his own. Mayer, standing next to Jeff there. If you don't know Mayer, so Mayer came from a real estate background himself. He's a business builder, had run his own business as well before that. Mayer's got a lot of experience in the new construction, design build. He's not only an agent himself, but this is something that is part of his investment portfolio. So between the two of them, there's a wide range of experience. Myself, also a real estate investor. My primary ended up being a lot in student rentals. I think that student rentals are one of the most effective ways to get into real estate. Sometimes the hardest, to be honest, just because of the way that banks feel about that right now. But I have a couple of student rentals, 4 units total, and I find it's a really effective way to be in real estate for a whole bunch of reasons, and we can talk about that. All of us have sort of different, diverse backgrounds, and we find that between the three of us, we always find a way to match up with the kind of experience that our clients are looking for, and give the information from either our own personal background or from our clients' past backgrounds. Okay, so now enough about us. This is more about you. So everybody sitting around here needs to know that you're in good company. Everybody here came with the idea of hoping to learn something, whether you're just getting started or whether you want to try and build and grow from where you've already been. So that's a good sign. When you guys registered, you gave us a little bit of information about yourselves. So I always like to sort of share with you what I found. About 1/3 of you already own your own home. So that's good news, because the primary residence that you own tends to be one of the greatest places to access capital for future investment. Sometimes the down payment is a hard thing to get, especially on an investment when you may need 20%. So about 1/3 of you already own your own home. That's great. A little bit less of you said that you were in the early stages. So maybe about 1 out of 3 of you are here not really sure if you want to invest in real estate, not really sure if this is the right fit for you. We're glad you're here. Getting information early in the process is one of the best ways to figure out if you're on the right track. So thank you for that. Aside from that, about 1 in 5, 17% of you are already on the path. You're planning to do something soon. So you either are already looking, or you're already talking with one of us, or maybe somebody else about learning how to get into this, and you're planning on getting into the market soon. So that's great. About 7% of you already own at least one property. So, or actually exactly one property. So that's great. So at each table, you might find somebody that already is investing in property and may have some experience that they might be able to share, either the goods or the bads. And most surprisingly today, about 20% of you already have more than one. So for those that came that already have more than one, thank you. You know, you guys are probably in a lot of ways experts, so, you know, please call us if we say something that you found that didn't work, didn't match with your experience. So with that being said, I want to tell you what the people who sat in your chairs the last time we did a seminar in this building did. So we've done a couple since then, but the one we did here was in May of this year. Since then, the people that were sitting in these chairs acquired over $11 million in real estate. So we did their mortgages, we helped them, you know, build that first step. So congratulations to them. Part of the mortgage process is evaluating how much rent they're going to earn. So those people combined are now earning around $80,000 in new monthly rental income. That's not what they're taking home, but the point is this is all about wealth building. So the folks that sat in your chairs between now and then are on that path to an annualized $80,000 a year, which is great. Not individually, of course, combined. Appreciation, you know, we'll talk about appreciation, and in today's market, appreciation is a really volatile subject, but in general, we find that the real estate market appreciates in Ontario around 5% a year, sometimes a lot more, and this year less, but in general, in the long run, that's what the stats have shown over the last 30 or so years. So those people are getting about $47,000 a month in appreciation that, by the way, we'll talk about, but they're not paying tax on yet, so this is just wealth being built in their portfolio. Over 5 years, that works out to over $3 million, those same people based on that same return. And over 10 years, it's about $7 million. So we're talking about the impact of one group like you. And the point is that, you know, for those that want to go fast, you can do this. And for those that want to take time and learn, we love doing these things more. So this is really great. And we're just, you know, we're so excited to see people, you know, come to these things and decide to do something afterwards. Doesn't mean you have to. This is not, there's no obligation to do anything at all. But the point is that this is the first step, is that connection and that learning. So, you know, thank you for being here. So now let's get into a bit of the nitty gritty. So the first thing I want to talk about is why real estate. I didn't mention earlier, but some of you might know that aside from my mortgage business, I also work to help people plan their investments and plan their retirement. And I work in life insurance, and I help people plan their life insurance investments. And I'll talk about how, you know, the markets are a great place to be. And, you know, life insurance can be a good investment in some cases, and all those things are true. Tonight, I want to talk about why, even with all those things in mind and my other background, knowing how, you know, the other parts of the world work, real estate is a really great investment for a lot of people. The first thing is, in real estate, you can see, we'll go through these things. Cash yield, what that really means is the amount of money that you can take home every month from this investment, okay? So we're talking about real estate versus maybe just bonds, you know, like fixed income investments, maybe the stock market. Everybody has a Wealthsimple account nowadays. Everybody was a, you know, amazing investor when they watched the markets climb, and now it's a little bit more volatile. But we're talking about comparing it to that, as well as, you know, cash in your savings account, right? Simple, reliable, something there. So some of those other options can produce monthly cash for you. I mean, fixed income is by definition going to bring you income. But what we found is that the single best value in buying and holding rental real estate is making sure that you are cash flow positive. Cash flow is number one, most important, and you can get it from real estate. The second is equity growth. So what we mean by that is, you know, the value of your investment goes up over time. So in the case of real estate, of course, you know that aside from some of the strangeness we've had in the last 2 years, a normal rate of return is about 5%. So you can get that from the stock market. In fact, you could probably get more in a lot of years. The next one, to me, is my favorite, because I think it's the thing that most people overlook, and that's leverage. So leverage to a lot of people sounds scary because it means debt. But with leverage, what you're doing is you're amplifying the effects of all the other things that are here. So what I mean by that is that when you go out and buy a property, let's say that you had to put 20% down on that property. If it's your own owner-occupied home, it's a lot less, but just for example, you're putting down 20%. Well, what that means is, in an example where you spend, say, $800,000 on a property, that down payment is about $160K. Now, go back to my discussion about, you know, rate of return and growth and equity. In an average market where you might make about 5%, we're not talking about, you know, 2021 or 2020 where it was like 15 or 20, but when you're making 5%, that's 5% on 800K in this example. So we're talking about, say, real equity growth of around, say, $40,000 a year. Now, that's fantastic, but you're saying, well, you know, 5% is not great. I get 5% in my, you know, Wealthsimple account. I'm a genius investor. Okay, that's true, and in a lot of cases, you know, people have been really successful there. But you're making that $40,000 on 160K down, because that's the only real cash that you put into the system, which means that your rate of return is essentially multiplied by 5 times. So that 5% is really more like 25. And when people start to realize the power of leverage, and someone says, well, I'm getting 6 or 7 in my, my mutual funds, which is true, and they can be great, or I'm getting something else, elsewhere. It's really hard to find great places where you can get that power of leverage. If you're investors, you might find that, you might get a margin account with the brokerage that you use, and maybe you get, 50 or 80%, so you can get maybe 2 times what you put in. But it's nowhere close to 5 times in real estate, and we're talking about usually that's in something that's a lot more volatile. So to me, the power of leverage that you see mostly in real estate, and of course not in other forms, changes the whole numbers here, because every dollar that you earn gets multiplied by the leverage factor. Of course, as long as you're cash flow positive, and we'll talk about that. The second last point is it's a hard asset. A lot of people still really see the value in owning something tangible. I mean, some of us around the tables may talk about, I know someone who really likes buying gold, or, I'm worried about the markets. And what do you think happens to the price of gold when things get a little scary? Like, it goes up because people flood into these assets that are considered safe, right? And so, believe it or not, a hard asset like cash in your hand, or in some people's cases, gold, is something that people have a lot of value in. I mean, the truth is they're not making more land. And then the last thing, but not the least, is the tax advantage. So I think the thing that's really important here to think about is that versus, say, stock, which, you're going to get a capital gain when you sell it, but versus bonds, it's just income, and versus cash in your savings account, it's just income. There's a tax difference between real estate appreciation, because number one, you're not paying tax on the appreciation as it goes. So you buy a property, say, this year. Well, as it grows in value at 5%, you're not paying tax on that growth. So your value continues to increase while you haven't paid the tax yet. It's not tax avoidance, it's just deferral. You're saving it for later, okay? On top of that, the tax on capital gains. So the sale of a real estate property after you've owned it for a while, and we're not suggesting you should sell it right away, but after a number of years, that's a capital gain, which, I'm not an accountant, I'm not here to give you accounting advice, but a capital gain is taxed at half of the rate of income. So if you have a salary job or a regular type job, or you own your own company and you have income, that income is taxed at your tax rate. Well, capital gains are taxed at half. Okay, having said all that, let's talk about how you actually make money, and I alluded to some of it before. So the first and foremost is cash flow is king. Cash flow, while I think for many people an afterthought, is often the most important component of your overall investment, because not only is it immediate income, which is nice, but it is your safety net. It is your protection. It is your emergency fund, right? It is what separates the volatile market, the changing market, and insulates you against feeling like, oh my gosh, things aren't great in the market, maybe we have to sell. If you have positive cash flow, you have the ability to be in this for the long term. So, we all have friends who've gotten into investing, and maybe they have negative cash flow and it's only, a couple $100s, and that's okay. But think about what happens when they start to worry about the price of houses, the price of real estate, and now they're pumping their own money in and affecting their own lifestyle. So for many people, seeking zero cash flow, okay, in some ways that might be the best you can get in certain markets, but seeking real positive cash flow separates your investment from what's happening in the market and really helps you to be able to make long-term decisions. Like my truck's sitting in the parking lot, I don't know what it's worth, I don't care, I'm not selling it, right? So in the same way, as long as that real estate's useful in producing cash flow, the value you can trust will do its thing in the long run, and you're not gonna be subject to, really short-term swings like people might have seen, in the last, like 6 months. Mortgage pay down. So I alluded to this a little bit earlier, but really what this is it's the debt we talked about that is, on the property that you're not paying for. So the tenant, the renter is paying down your mortgage, which means that every single month, on the average mortgage, when you start, about half goes to principal and half goes to interest, okay? For lack of making it simple, because my math's really bad. So imagine you have a mortgage payment of a few thousand a month. Now, basically, of that, say $3,000, $1,500 is actually going in your pocket every single month. I mean, you don't get to spend it, but it immediately paid off the mortgage, reduced your liability, your interest expense in the long run, and I mean, the CRA even charges you tax on it, so be aware of that. But the fact that your mortgage is getting paid down by somebody else, You know, I had a client say to me the other day, like, I get that there's a debt, but I don't pay it. So that's good. And again, that all comes back to having positive cash flow. Okay, so mortgage being paid down. Principal recapture just means you're recapturing more of the principal. And you can, again, in the same way, you can eventually, as you build up value in that property, build up equity, you can actually use that equity to purchase more investments, right? So that's another way of looking at it. The third one is forced appreciation. So, you know, if you've been out there researching, investing in property, investing in real estate, you might have heard that term before. You might have heard of people talking about the BRRRR method, right? Talking about buying a property and renovating it, and refinance and repeat, right? That's what people call the BRRRR method. Forced appreciation is really what happens when you buy a property that you realize has potential. You make some sort of improvement on that property to raise what the rent could be worth, make the property more valuable. Maybe you buy a single family home and you duplex that property, you double what the rent it could earn. So the old person that owned it before, either they lived in it or they're renting it, but now it can earn double the rent. So guess what one of the biggest things is that goes into your mortgage application when you're trying to invest in property is what is your rent? So what you've really done here is you've, in a lot of ways, doubled or drastically increased the income on that property and what somebody else will pay you to buy it and what you could earn. So forced appreciation is appreciation that you force by renovating or improving the property. And the last one is passive appreciation. So we talked about that a little bit earlier. Passive appreciation is, you know, basically the idea that, you know, a rising tide lifts all boats. It's the, you know, 4 to 5% normal amount of appreciation in the real estate market in Ontario in the long run. It's not what's going to happen this year necessarily. It's not what's going to happen last year necessarily. But in the long run, if you hold for at least the period of your mortgage, you know, people plan to say 5 years, you're going to see that that number tends to, over history, it tends to equalize around 5%. These are the, in my opinion, some of the best ways to earn money in investing in real estate. There are lots of other ways to do it too, but these are the ways I think that stand out for me when I was a new investor for the first time. So this is the way we think we could show you guys how to earn in real estate. The next question that people usually ask is, okay, that's great, but how do I actually get the mortgage, right? How do I actually do that? Because, you know, as we talk about cash flow and talk about getting into real estate, you still have to get approved of the mortgage, right? And people wonder, well, how do I have 2 mortgages? So Jeff, you want to come up maybe and take over? I'll hand it off to Jeff, who's going to talk about the secret sauce behind how a lot of our clients can get a mortgage.
Hello, everyone. Can everyone hear me okay on both sides? Thank you, David. So I get the short straw in this case, where I go into the mortgage details. So if I see your eyes start to glaze over, I'll stop for questions. The biggest question that I get, or the biggest referral source that I get, is one investor hits a wall at their bank. Their bank says, hey, you can no longer purchase any more real estate. And then they talk to their other real estate buddies who have worked with us. And they say, yep, I didn't worry about it. He says I can buy 3, 4, 5 properties, no problem. And they call me and they say, how the heck can you do it? And it's not some secret formula that we have. At the end of the day, how a standard bank looks at your rental property is they look at your rent, okay? They actually say, we're going to only consider half of the rent because there's a risk that someone might not pay. And then your debt on the monthly payments, the property taxes, and the heat count against you as a negative. So what this means is your properties have to have 4.5, so somewhere between 4 and 5, depending on the property, 4 to 5 times more rental income than they do the debt in order for you to actually qualify. So the other factor that we use to help people purchase real estate is what's called an offset. Okay, and an offset is essentially just taking our rent, subtracting it from the debt. Remember that income and debt, the debt is over 2 times worse than the income. So this subtraction actually makes a huge deal when we're talking about real estate investment. So to the point of cash flow being king, not just is it important for you, your sanity, as markets start to decrease or interest rates start to rise, but also from a qualification standpoint, if you're able to have rent that carries the mortgage and we can use these offsets, it greatly impacts your ability to purchase. So for most people who we qualify mortgages with. If you're able to qualify for your first mortgage, we're able to qualify you for mortgages 2, 3, 4, and 5 at the same amount that we did for mortgage number 1. What we suggest is we'll look at somebody who's purchasing their first home. There was 60% of people here who have not purchased their first property. If your plan is to buy rental properties, we need to know that up front. So we actually work with you to structure your first home, even if it's not a rental property, which will allow for you to purchase properties 2, 3, 4, and 5. Doesn't mean that everyone here is going to purchase 5 properties. That's not the goal, and that's not at all what we're expecting. What is important is for each person here that we have you set up for your specific goals. Each person that I talk to, or each person that Mayar or David talks to, has a different plan because each person is individualized in what they're actually looking for. So the most important thing to factor is when you're walking into your bank, when you're talking to a mortgage broker who might not be real estate investment focused, it can put a damper on future purchases. So for instance, when we're talking about mortgages that this 50% add back. So in most cases, it's beneficial for us to use some of those lenders who have the lower interest rates up front. So because when we're purchasing number 3, 4, and 5, you may go into your bank and they'll use one set of pattern where brokers are actually able to use some of these offsets, even though when you walk into the branch, they won't do so. So we have opportunities, or brokers have opportunities that specific lenders actually don't have. This is why cash flow being king, not just on your end, because we get a lot of calls. Most of the calls that we get in a down market are for people who have been putting money into their investments. Because when you're putting money into your investments and they're going up 20%, everybody's happy. Now, when your investment's starting to go down, which we've had over the last 6 months, in that case, you're putting money into an investment that you feel like is losing money every month. So from a mortgage perspective, the biggest thing is let us walk you through things from step 1. If you're a person who's just looking to purchase their first property, haven't looked at purchasing a rental, and that's something you might look for in the future, let us know. And if you're someone who does want to purchase 3, 4, 5, 10, 15, however many properties that you want, we can come up with a personalized plan for someone like that as well.
So I'd like to highlight an example using cash flow that's made the difference between someone getting into the real estate market versus not investing at all, just by getting out of their comfort zone. So we're looking at a situation where we have a condo in town versus a single family home elsewhere. It could be in another city. I'll use Kingston as an example because that's where I live, and that's one of the biggest growths in terms of real estate this year and last year. But basically, most people will look in their own town and they'll say, okay, well, I'm going to look at a condo in town. That's what I can afford. It's not a detached property. I can likely get it for around $700,000. You can also look at something out of town, which is $700,000 with the purchase plus improvements, and that's a detached home. So value-wise, it's the same mortgage. The difference is that down payment is the same, obviously, at 20%, and monthly payments will be, and we're basing that based on a 5.1% rate because we're trying to be more realistic in terms of today's market, as we know that rates have changed even since the last time we did this presentation. So based on that, we're looking at condo fees on the condo in town. Obviously, there are no condo fees for your detached residence. And you don't have the option to duplex your condo. But if you buy a property, you obviously have that option to do some renovations, duplex it. Property taxes, obviously on a detached, are going to be a little bit higher than they are on your condo. But the rent that you're going to get realistically based on today's market is somewhere around $2,600 a month plus utilities. And on a single family home, we're looking at approximately $4,975. So the difference between investing in a condo in town, you're looking at a cash flow being king, a monthly loss of around $1,225, whereas on the detached property out of town, you're actually cash flow positive. The 700,000 is another example I want to point out. We did this in May, the same seminar, and someone ended up doing this exact same thing. They were looking in Toronto. They had to buy in Toronto because they've lived in Toronto. Realistically, you can't buy anything in Toronto for that price. So we recommended they look at something out of town. They ended up buying what they purchased plus their improvements for 450. But we're using 700 just to make a point here. There are opportunities outside in areas where the rate of growth is actually, even in a market where overall a lot of markets are seeing a decrease, there are markets in the province that are actually still either even, which is essentially a net positive, or markets that are still increasing in value. There's a lot of importance in the way that placement happens. So setting up your first mortgage, what that means for the second, if you want to go down the road and get 4 or 5 properties, it's really important to set up all of those mortgages properly, place them at the right lender so that you're using the, if it's an offset versus whatever, that basically you're taking advantage of those lenders and maximizing that at the right time. That's what we specialize in. Previous seminar, when we did this, based on the last numbers, so market rates and way things were selling for in rents, the difference, the loss there was about 200, and the gain was about 1233. So what you'll see actually, the rent increase as a result of what's happening in the market, rates going so high, people not being able to buy a property, more renters enter the market, and obviously the rental prices go up. So that's where you're seeing that difference increase, even in a market like this.
This example we call build your base. So what we start is with a property purchase. So this is an example of someone who doesn't currently own a property, who wants to purchase rentals at a breaknecking pace. Okay, they want to buy as many properties as humanly possible as quickly as they can. This build your base, the reason why I love this as a basic strategy is because of what it allows for you to do moving forward. Okay, so building your base, we start off by purchasing a house. When we bought the house, I was moving into it. So I put 5% down. That was back in the day when it was 5% no matter the purchase price. Now it's 5% of the first 500,000, 10% after that. But I was able to put the minimum down payment down. Then I did the renovation. I refinanced that house in order to purchase another property. So the benefit of this, we're talking about leverage. In an investment property, you're looking at 5 times leverage, right? You're putting 20% down and the other 80% is coming from the bank. For me, I was able to put 5% down. That meant 95% was coming from the bank. I was renovating the basement. I was making it into a duplex, allowing for rent upstairs and downstairs. Then I purchased house number 2. Now, when we bought house number 2, the most common misconception is that you need to put 20% down. That answer is not true if you're moving into the property. So it's not like some of the other benefits of first-time home buyer. You can have multiple properties with less than 20% down. The key is you have to move into those properties. So what could I do? I put 5% down. I moved into the basement. I did a renovation. Now I could rent both units. I bought house number 3. So this benefit allows for us to grow our portfolio very quickly. Is this for everybody? Absolutely not. Some people are looking at this and they're scared for me, right? I understand that, or scared for someone doing this type of philosophy. So what I'm saying here is this is not for everybody. So with this, you can go as fast or as slow as you want. The most important thing is making sure that we find the right property, but we also match what type of investor you are or your risk tolerance to a strategy that makes sense. Those lenders, once I refinanced, I actually moved away from them so that I could do it again the second time. And this is the importance of layering or structuring our loans to make sure we know what we're looking to do long term. So if I had just refinanced with that first lender that I went to, I wouldn't have been able to get the purchase plus improvement on the second loan. So in this case here, the benefit is each of these homes are cash flow positive. And at the end of the day, each property that we have, because the first two were with less than 20% down, but even the third one was an owner-occupied property, insurers actually have some of the best offsets in the market. Insurers meaning if you're putting less than 20% down, CMHC, Genworth, which is now called Sagen, and Canada Guarantee, they love rental properties and will say, we'll do a great offset for you. And these lenders take advantage of it because there's no risk to them. If you don't make a payment, the insurer will actually cover any loss that they have. Doesn't actually benefit you, it benefits the lender, but they feel like there's less risk. In a lot of cases, when you talk about, when we run through active appreciation and duplexing properties, we want to make sure that we can at the very least take all of our money out that we put into it for the renovations and then some. So that means because you can only take out 80% of the increase in the value, that we want to see for every $100,000 you're putting into it, that you're getting $125,000 at a minimum in value.
Previously, we talked about getting out of your comfort zone to get into the market, and I had some questions during the break as well. How do I do that first one? So, I talked about getting out of the comfort zone to be able to accommodate that type of move, but like Jeff said, we want to highlight examples of what people did at their own pace based on what worked best for them and their family. So the two scenarios are, one is income replacement and the other one is equity investment. So they're two different reasons.
We'll talk about the equity investment first. So we've had clients start by selling their home, moving into a property, adding a basement unit and making a duplex. And they repeated this 4 times for a total of 5 homes, just like Jeff had indicated. The total purchase was just over $1.7 million between the 5 properties, so an average of about $340,000 per property. And now they're worth around $1.15 million. They purchased 2 properties on an acreage, severed them into 3. On the 6 properties, 5 were sold for between 1.4 and 1.6 million, and the last one was kept as a cottage. They then went to purchase a $2.2 million property to live in with their money, and obviously they were free and clear. They were able to get a HELOC on that, so home equity line of credit, meaning since there's no mortgage, they have that investment portion and they can use that at any time if they wish. So that's, again, that's an equity investment approach. Now let's say we've had another person who wanted to replace their income. They didn't like their boss or their job, and they wanted to basically come out of that, have enough income to replace that. They came to us wanting to quit, as I mentioned. They started by refinancing their primary residence. They purchased 3 rentals, renovated each, adding a basement unit again to each of those. They purchased 3 multi-unit buildings ranging from 8 to 20 units. And I'll get into this just before I go into the next point. One of the things that we've noticed is once you get into acquiring 4 or 5 properties, a lot of accountants will recommend getting into the multi-units, as we had indicated, Dave and Jeff have both indicated, due to the tax savings and the implications. There is an extreme case. Again, it's not every client, but we do have a client who their accountant every year tells them to buy a multi-unit in order to not pay taxes to the government. So this is the amount of income that this person has. Now, it doesn't happen to everybody, but there is a reason, there's a place, and that's why you'll notice that the multi-units do come in just based on the amount of revenue generated. So there's a reason why this comes into play here. So then we refinanced 3 standard rentals and the 2 multi-units through CMHC. And these funds allowed to pay out the multiplex and purchase another one without a mortgage. So just by doing that. So that's about $186,840 in total cash flow per year, which is what they needed to basically pay out their own mortgage and eliminate that payment. And again. So that basically replaced the rake.
Thanks, Mayor. Okay, so this is a lot of great information. It's, some of it may seem overwhelming. Some people may get the sense that we're telling you always have to buy 5 properties. The truth is that it all starts with a great team, and we're not suggesting that everybody here should even buy 1. This is about information to help you learn what makes sense for you. Every investment requires, learning first, and I think you guys are all in the right spot to do that. But none of this really works without a good team. And what we mean is that every really high net worth person out there, every really successful person always has a team behind them. Whether it's your family that is your team to support you, whether it's the people that you work with in your industry at work. But the point is that none of the things we could do, you can do without a great team. So when we talk about this, what we really mean is, we are part of that team. You're a financer who's going to help bring you the right financing that helps you build your portfolio to what you want. We're also talking about property selection. We're also talking about your realtor. There are a couple of great real estate agents here in the crowd tonight. If you have somebody that you know and trust, make sure that that's the kind of thing that they want to help you find, right? And be upfront with your expectations about what you want to do. And find somebody you can trust. So that all goes into it. Mayor talked about your accountant asking you to spend some more money. I want your accountant, by the way. So the point is, you want to build a team around you of people who can help you to accomplish the things you want to accomplish. Okay, if you're going to be buying more than one, over time it becomes things like accountant, lawyer, realtor, contractors. And in our case, we're lucky enough to have a lot of those connections. You in your own markets may have your own people you trust as well. Maybe some of you are contractors or no contractors, but the point is that it's all about assembling, the right team. So don't overlook the value of having the right connections, and keep looking around until you find somebody that can really deliver what you want and that you can trust. With that being said, from here, what do you want to do next? So, Jeff, Mayor, and I, we welcome every opportunity to sit down and talk real estate, talk investing. Nobody comes and says they want a mortgage, right? A mortgage is a means to an end, right? So, think about what it is that your goals are, and we're happy to talk about it. That being said, questions, feedback, anything, we'd love to hear it. So thank you very, very much for coming, and we hope you guys come back to the next one.